Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA N. Raja, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. What do we mean by liquidity? Liquidity means ability of the business to meet its short-term expenses and obligations without any difficulty. So in liquidity ratios, we are actually trying to understand whether the business is having any pressure to meet its obligations. For that, let me take you through the memorandum of a balance sheet. See, in business, funds can come from various sources. Funds can come from owners. It can come from outsiders. When funds come from owners, we call it as equity. When it comes from outsiders, we call it as liabilities. The money that are coming from outsiders, what we call as liability, can come with an obligation to repay within 1 year. It can come with an obligation to repay after 1 year. When it comes with an obligation to repay within 1 year, we call them as short-term liabilities. So these are all the money you have raised, maybe in the form of cash credit or overdraft or advance from customers, and you have the commitment to either repay them or to deliver the goods in case of advances. So using this money, what you will do? You will create some assets, basically short-term assets. But if you look at the proportion here, the short-term assets are greater than the short-term liabilities. It means what you have created as assets is greater than the money what you have borrowed in short term. It means these assets could not have been created with just short term funds. Some more funds have come in for creating these assets, and we call them as long term funds. It's only because of that reason the short term assets are greater than the short term obligations. So what is the relationship of this scenario with the liquidity? It has. When short-term assets are greater than short-term liabilities, that business will have comfortable liquidity position. It means short-term liabilities are repayable within 1 year, and for repaying you need resources, and those resources are actually in the form of short-term assets. So if you want to repay 10 million, and if you are having a short-term assets of 15 million, it means you are having resources of 15 million using which you can pay 10 million. We can say the liquidity position is comfortable. Okay. To understand this even more in depth, let's understand something very important now, that is fund utilization principle. Whoever attending this workshop, please take this principle to your heart, to your mind, and try to teach this to as many entrepreneurs as possible. Educate the entrepreneurs, whether you be a banking executive, a credit officer, or a relationship manager, or a chartered accountant, or cost accountant, or finance manager. Okay, this is very important, because 95% of the business units have failed only because of not understanding this principle. Only 5% of the business units are failing or becoming NPA or becoming sick company because of technology, because of marketing, sales, quality, HR, legal issues. Remaining 95% of the businesses, they fail because of one single reason, that is they have not understood how to utilize their funds. Let me take you through. I said funds can come from owners and outsiders. And when funds come from outsiders with a commitment to repay within 1 year, we call them as short-term liabilities. And using those short-term liabilities, short-term assets can be created. But short-term assets is greater than short-term liabilities. It means automatically it gives rise to the understanding that a portion of short-term assets is funded by long-term funds. And what we can infer, the remaining long-term funds are being utilized for creating long-term asset. So in this way, we can break any balance sheet into these 4 compartments. But what's even more important is how these funds are going to be utilized. Short-term liabilities can be used for creating short-term assets. Good. Long-term funds, that is basically the composition of long-term liabilities and equity, can be used for creating long-term assets. Good. Long-term funds can also be used for creating short-term assets. That's ideal because that's going to give the much needed liquidity comfort for the business. Whereas there is one thing which should never ever happen in any business. Never ever divert short-term funds for long-term purpose. Never ever divert short-term funds for long-term purpose. Because whoever have given money for short-term period, they are going to ask that money, they are going to ask you to repay that money in that short-term period. And if you are not going to meet that commitment, repay that in short-term period, then that becomes the beginning of end of your business. Because they will go for all the legal recourses available. Just imagine the short-term money was given by a banker in the form of a cash credit or overdraft. And it has become due for payment. He is demanding the payment, and when you look back, you don't have short-term resources because you have used that money in creating some land or building or plant and machinery. So it's sitting in the form of a long-term asset. So how long they will wait? If a banker, if the loan amount has become overdue, they'll wait for maximum 90 days. Then they'll declare the account as non-performing asset and they go for recovery measures, right? So that's why I say that becomes the beginning of end of a business. So never ever divert short-term funds for long-term purpose. With this understanding, let's move on to the first ratio, that is current ratio. I'll take you through 3 scenarios, but before that, let's look at the formula part. So how do we calculate current ratio? Current ratio is calculated as current asset divided by current liability. Current asset in the numerator, current liability in the denominator. What are current assets? These are all the assets which can be converted into cash within a period of 1 year. What are current liabilities? These are all the liabilities which have to be settled within a period of 1 year. Obligations got to be settled. And this is how scenarios should be for every business. That is, current assets should be greater than current liabilities. Let me take you through those 3 scenarios. Look at this. Scenario 1. Here you see current asset as 600. Let's say 600 million. Current liabilities as 300 million. So from this, what we can infer is this business has an obligation of 300 million to be settled within a period of 1 year, and for that they have corresponding resource, current asset of 600 million. It means they are having a comfort of remaining 300, so I call that as net working capital. So how I derive this net working capital? It is very simple. Current asset minus current liability gave me net working capital, and these net working capital are nothing but the long-term funds. So what we can infer is this long-term fund of 300 and short-term fund of 300 is used for creating short-term asset of 600. So that's one way of looking at it. The other way is within 1 year this business has to settle 300. For that they have resources of 600. It means they still have comfortable margin of 300. And now if I calculate current ratio, which is current asset by current liability, 600 by 300, I get the ratio as 2:1. It means for every 1 rupee obligation, there are resources of 2 rupees. I repeat, for every 1 rupee obligation, there are resources of 2 rupees, and that's why I say liquidity is comfortable here. Whereas in scenario 2, Current assets are 300 and current liability is also 300, and if I calculate net working capital, which is current asset minus current liability, it's nothing. It means this entire current assets was created by current liability only. So there is no long-term fund contribution for creating this current asset. And if I calculate current ratio 300 by 300, I get it as 1:1. 1:1. It means for every 1 rupee of obligation, I have resources of 1 rupee. For every 1 rupee of obligation, I have resources of 1 rupee, but not all times this 1 rupee resource will come for rescue. There will be some issues that you will understand when we go through quick ratio. Look at the scenario 3. My current assets are 200, current liabilities are 300. So what does that mean? I have borrowed 300 with a promise I will repay within 1 year, but what I have created with borrowed money is only 200. So what happened to that remaining 100 which I have borrowed? I borrowed 300 short-term money. I am supposed to use that for short-term purpose, but instead I have used that remaining 100 elsewhere, where obviously for long-term purpose, because current asset is the short-term purpose. In current asset I could see only 200. So what happened to the remaining 100 that had gone for supporting the long-term purpose? And that is the last thing which I said in fund utilization principle. Never ever divert short-term funds for long-term purpose, but that's what they have done here now. And if I calculate net working capital, which is current asset minus current liability, I'll get 200 minus 300. What I'm getting is negative 100, and this is what the fund they have diverted from short-term purpose to long-term purpose. So whenever there is a diversion of short-term funds for long-term purpose, you will see a net working capital being negative, and you will also be in a position to notice that by looking at the current ratio. Because calculate current ratio now, current asset divided by current liability, 200 divided by 300, you get current ratio as 0.67:1. It means for every 1 rupee obligation, I am having only 67 paise. It means there is a clear-cut shortage of 33 paise per rupee of obligation. So we can say in scenario 3, this business is in serious trouble, because within a year they have to settle 300 million, they have resources of only 200 million, and it is also very much evident by looking at current ratio, because for every rupee obligation they have only resources of 67 paise. So these kind of inferences are possible when you look at current ratio. Okay, for calculation it is very simple, but what it communicates is something very important, something really significant in decision making. Also it is very relevant. Okay, right. Next, I'll also take a couple of minutes to explain why current ratio of 1.33 is insisted by most of the banks. Some banks, of course, they'll have like 1.1, 1.33, 1.5. Okay, let whatever be the logic what I place here, you can extrapolate for 1.1, 1.5, 2 also. Okay, listen. Let's say my current assets are 100 million and I'm having current liabilities of 75 million. And with this, if I calculate current ratio, I get current asset by current liability as 100 by 75, that is 1.33. So it's going to be 1.33. So when the current ratio is 1.33, automatically what we can infer is 75% of the current assets are funded by current liabilities, and what we can derive is the remaining 25% of the current assets are funded by long-term funds. Because current asset minus current liability we call as net working capital, right? And net working capital is nothing but the long-term funds which had come for creating this current asset. It means there is a 25% long-term fund contribution for creating this current asset, and this is what most of the banks stipulate as a sanction condition, basic sanction condition for releasing working capital credit facilities. For example, if you go and check back the sanction letter issued by your banks for cash credit facilities, generally the margin condition on inventory will be 25%. So It means 25% of the inventory have to be funded by long-term funds, right? So this 25% long-term fund contribution basically represents 25% margin condition stipulated by banks for working capital, and this is the logic behind 1.33. So when the current ratio is 1.33, the conclusion is 25% of the current assets are funded by long-term funds, which is in sync with the sanction condition, the condition stipulated by the bank as working capital margin. Next, we'll move on to quick ratio, also called as acid test ratio. So look at this scenario so that you can understand this better. Current liabilities are cash credit 100, sundry creditors 200, whereas current assets are cash and bank of 100, stock of 100, and receivables of 100. Okay, so the total both sides is 300. So this is exactly our scenario 2 in current ratio discussion. This is what our scenario 2, and I said it might look like an ideal scenario, but this is not an ideal scenario. Okay, now why this is not an ideal scenario, even though the short-term funds are exactly used for short-term assets? This is not an ideal scenario because some of the current assets, say the stock, this stock will not be available when you need cash immediately, because you have to convert the stock into, let's say the stock is in the form of raw material, then you have to convert that as finished goods. Then you have to identify a buyer. Then if he insists on credit, again it will take its own time. Okay, so for that reason this stock is not immediately available. So what is our total current assets now? It's not 300, it is 200. So we call this as quick assets. Current assets was 300, but what is available at a faster pace or quickly is only 200. Now let's compare. And before that, let me put that in the form of a graph. That is, here this blue bar is my obligation current liability. My resources or current assets, it looks like matching, but this orange bar will not come for rescue, because of that what is immediately available is only to this extent. Only quick assets are immediately available. Even though I have lot of current assets, what is immediately available for me to settle my current liability is only quick asset. So there is a gap. That's why we calculate the quick ratio, or say the acid test ratio. So here we know current assets are 300, but quick assets are only 200, and we have to compare that with the current liability. So quick assets by current liability will give us the quick ratio. In some balance sheets on the asset side, you will also have an item called prepaid expenses. Okay, this is already paid for, so it is not going to fetch you any cash within a period of 1 year, but it is actually helping you to reduce the payments within a period of 1 year. So from current assets, as we have removed stock, we should also remove prepaid expenses. That will give us quick assets. And if that is divided by current liability, you get the quick ratio. In this case, current asset by current liability, 300 by 300 gave us a current ratio of 1:1. But if you want to know the real face of it, you have to take quick assets divided by current liability, 200 by 300, you get only 0.67:1. So for every 1 rupee of obligation, the quick assets that are available is only 67 paise. For every 1 rupee obligation, quick assets that are available is only 67 paise. So how a quick ratio should be, or how a liquidity position of a business should be. Look at this. This blue bar is your obligation. If you have 300 as your obligation, your current asset should not be exactly equal to 300. It should be greater than 300. Okay, roughly let me say it should be like 350. Actually, it should be greater than 350, because there is a kind of benchmark ratio for current ratio, right? The benchmark ratio is, I mean, theoretically it is 2:1, and what is widely accepted is 1.33. Okay, and here I have used the number 350, but you just focus on one understanding, that is current asset should be greater than current liability. But our focus is on preferable liquidity position. Current assets should be greater than current liability, but quick assets should be at least equal to current liability. Okay, that's the message we should take now. Current assets should be greater than current liability in such a way that current ratio is 1.33 or 1.5 or 2:1, but quick asset should be at least equal to current liability. It means quick ratio should be at least 1:1. Only then that business will have real liquidity comfort. What is the point in having a current ratio of 2:1 when all the current assets are in the form of stock? It will not fetch, it will not give any money when you are in urgency. Okay, that's why we say quick ratio should be at least 1:1. Thank you so much. We have come to the end of this webinar, and I'm sure you would have really derived value from this short and crisp webinar. If you wish to continue this learning journey, I have an amazing opportunity for you. It is this Credit and Financial Analysis Mastery course, exclusively designed for bankers and for those who want to have bankers' point of view. This is a course which we have developed after a detailed analysis, a thorough discussion with several hundreds of bankers and finance professionals. We have identified what is their exact requirement when it comes to SME and corporate credit and financial analysis. In this mastery bundle, I'm going to give you access to various courses. To start with, we have course number 1, Basics of Credit Analysis. In this course, we have explained the basics of credit analysis through various sections, section 1 to 9. Next comes course number 2, that is how to read balance sheet. In this course, we have explained what is balance sheet, how to read them, how to approach them by using real life financial statements. Then comes course number 3, how to do financial ratio analysis like a banker. In this course, we have explained all critical ratios that are analyzed by the bankers, and we have also explained through case studies. Then we have course number 4, how to do cash flow analysis. So through this course you will understand what is cash flow analysis, how to do a typical cash flow analysis. We have used case studies, and reference to Ind AS is also included in this course. Then we have course number 5, that is how to do fund flow analysis. This is a critical financial analysis tool, and in this course you will learn what is fund flow statement, how to analyze them from banker's angle, how to prepare fund flow statement from academic angle as well. So overall 5 courses, each 1,499. So aggregate price should be 7,495, but you are not going to pay that. For you, it's just rupees 2,499 for 1 year access, or rupees 4,999 for lifetime access. And it is not yet over. You have some more bonus. Bonus is course number 6, how to carry out credit risk rating for non-trading entities. These are all the topics covered in this course. Then course number 7, it is how to carry out credit risk rating for trading entities. Not yet over. You also have access to course number 8, that is how to prepare CMA report for bank loans. It's a comprehensive course which will run for 8 + 5 hours, and you will learn entire CMA report preparation process. And course number 9, how to prepare cash budget for bank loans. Course number 10, how to assess fund-based working capital. So in this course you will understand what is working capital, what are working capital credit facilities, and how to assess them, what are the key ratios that are related to working capital, and what are the additional key analysis that will be done by bankers on working capital matters. You will get a comprehensive understanding of cash credit, export finance, and there are certain on-demand videos as well. So 5 + 5, 10 courses of value close to 15,000 rupees, but you are going to get it for 1 year access rupees 2,499, lifetime access rupees 4,999. Not yet over. You are going to get access to the 11th course, how to assess non-fund based credit facility. So in this course you will learn about letter of credit, bank guarantee, its assessment as well. Then comes course number 12, how to do term loan appraisal and assessment, because it's a complex process with a lot many technicalities. So this course covers all in detail. And course number 13, basic elements of loan proposal. So how a typical loan proposal will be, what are the basic elements that are covered in this course. And we have course number 14, case study on credit analysis. Various case studies based on practical experience and discussion with various bankers and finance professionals are included in this course. And course number 15, this is about
about collateral securities, where you get knowledge about collateral securities. So overall, it's 15 courses of value close to 22,485. It's 1,000 plus lectures. You can subscribe for 1 year access or lifetime access as you wish. These are all pre-recorded courses, so you can access them anytime as per your convenience. You can access them in mobile app or desktop, and for you the price is not 22,485, it is rather 2,499 for 1 year access or 4,999 for lifetime access. You can check the link in description, where without using any discount coupon code you can enroll at this discounted price, because it's a discount applied link. And not yet over, you're also eligible for some more bonus. The bonus is access to various ebooks and e-resources. You are going to get access to various financial ratios ebooks, financial management related ebooks. You will get access to financial analysis related ebooks, credit analysis ebooks. Not yet over, you will also get access to other resources like test series, templates, audiobooks, video books, career guidance material, and a bonus resource. Check the link in description and enroll now.